Chinese lawmakers have submitted a motion to introduce estate and gift taxes, a move that could reshape wealth distribution in the country. With China facing slowing tax revenues and a widening wealth gap, is this the right time for a tax on inherited wealth? Let's take a look.
The notion of a so-called death tax is gaining traction among China's leaders. Commonly known as an estate or inheritance tax, this levy applies to assets passed down after death. Many developed economies, including the US and the UK, already impose such taxes to prevent wealth concentration and support social programs. Now, China is reconsidering a similar move. A motion to introduce estate and gift taxes was submitted at the recent two-sessions parliamentary meeting. Supporters argue that reforming China's tax system could help redistribute wealth and boost domestic demand. However, no official draft or timeline has been announced yet. This proposal comes as China struggles with slow tax revenues, particularly at the local level, due to a prolonged property market downturn. With economic challenges mounting, the debate over whether these taxes are necessary or even viable has intensified. China's broader economic landscape is under pressure. The government has raised its deficit to GDP ratio to 4% for 2024, up from 3% last year, while planning to issue $180 billion in special treasury bonds in 2025 to stimulate growth. Meanwhile, local governments, heavily reliant on land sales, are facing declining revenues, making new tax measures an urgent consideration. At the same time, China's wealth gap is widening. The wealthiest 130,000 families now control 58% of all high net worth household assets, up from 56% a year ago. This according to the Huron Research Institute. Meanwhile, China's per capita disposable income stood at $5,700 in 2023, reflecting a modest 5.3% year-on-year increase. The push for estate and gift taxes aligns with Beijing's broader vision of common prosperity, a policy aimed at reducing income inequality. But with private sector confidence still weak, many wonder if this is the right time for such a drastic shift. Despite the potential long-term benefits, introducing an estate tax now could bring economic risks. Critics warn that it could discourage investment, reduce consumption, and accelerate capital outflows, further straining China's fragile economic recovery. With concern over private sector confidence and slowing economic momentum, experts say Beijing must tread carefully. As one analyst puts it, the key question is not whether these taxes would be useful, but whether their introduction is viable right now. For the moment, China's leaders face a delicate balancing act, pushing tax reforms while ensuring economic stability and investor confidence. Business Bureau, WION, World is One.
For all the latest news, download the WION app and subscribe to our YouTube channel.